Warren Buffett's entire life is a case study of compounding. He was able to go from a net worth of $5,000 at the age of 14 to well over $100 billion by the age of 92. This was in large part due to the fact that Warren Buffett was able to outperform the S&P 500 during every decade of his investing career. While there have been many other wildly successful investors, the reality is that no one has been as good as Buffett for as long as Buffett. So in this video, you're going to be getting hours of Buffett's best wisdom over the decades. You can also get a document of all of Warren Buffett's public writings throughout the years at the link in the description completely for free. So with that being said, sit back and enjoy the timeless wisdom from Warren Buffett. Timestamps are in the description.
Is how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
A broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
And in the science of hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game, and it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time.
What we're trying to find is a business that for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage, or any kind of reason at all that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. But we are trying to figure out why is that castle still standing, and what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now. What are the key factors, and how permanent are they? How much do they depend on the genius of the Lord in the castle? And then if we feel good about the moat, then we try to figure out whether the Lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses.
Realistic. You have to just define your circle of competence accurately. You have to know what you don't know and not get enticed by it. You have to have an interest in money, I think, or you won't be good at investing. But I think if you're very greedy, it'll be a disaster, because that will overcome rationality. But I think the same books I read and really molded how I thought about businesses and investing. I think that they're just as valid now. I mean, I haven't seen anything in the last 25 years, and I glanced through most of the books anyway. I've seen nothing to improve on Graham and Fisher in terms of the basic approach of going about investing, which is to think about stocks as businesses and then think about what makes a good business. And really, that's all there is to investing, and having a margin of safety, which Ben talks about, and so on. It's not a complicated process, but it definitely requires discipline. It requires insulating yourself from popular opinion. You simply can't pay any attention to it. It just doesn't mean anything. So the idea of listening to lots of people tell you things and all that, it's just a waste of time. You'd be better off just sitting and thinking a little bit.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses. But buying Berkshire Hathaway itself was a mistake, because Berkshire was a lousy textile business, and I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that, I was taught that, we'll say in 1949 or 50, it made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business. And that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, or perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of that mistake, and I would have been way better off taking what I did with Berkshire is I kept buying better businesses. I started an insurance business, See's Candy, the Buffalo, all kinds of things. I would have been way better doing that with a brand new little entity that I'd set up rather than using Berkshire as the platform. Now I've had a lot of fun out of it. I mean, everything in life seems to turn out for the better, so I don't have any complaints about that, but it was a dumb thing to do.
If we could see in it, looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate the strengths and weaknesses of the company and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out. Not by selling it to somebody else, because that's just a game of who beats who, but by, in a sense, by what the asset itself produces. That's true if you're buying a farm, it's true if you're buying an apartment house, it's true if you're buying a business.
Say you'd taken that $10,000 and you'd listen to the prophets of doom and gloom around you. You'd use the $10,000 to buy gold. Now, for your $10,000, you would have been able to buy about 300 ounces of gold. And while the businesses were reinvesting in more plants and new inventions came along, you would go down every year and look in your safe deposit box, and you'd have your 100 ounces of gold, and you could look at it, but it didn't produce anything. It was never going to produce anything. And what would you have today? 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive.
Well, you did what you wanted. I mean, you followed my advice. I'm batting 1,000. We'll see what you're batting next year. Yeah. Well, I won't comment on the 3 companies that you've named, but in general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but yeah. It's true, actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on, and if you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it. You'll probably learn a lot more with him by coming to this meeting. But it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died, and he owned 20% of the business, and I want somebody to go in with me to buy that 20%. And the price looks a little high, maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. And it won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some some added money when, at some time when something dramatic has happened. I mean, we did well back in 1964 because American Express ran into a crook. You know, we did well in 1976 because Geico's managers and auditors didn't know what the loss reserve should have been the previous couple of years. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.
My name is Mark Hake. I'm from Scottsdale, Arizona, and I'm very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is you don't need it. I mean, if you have a really wonderful business is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Well, in respect to real estate, it's so much harder than stocks in terms of negotiation of deals, time spent, the involvement of multiple parties in the ownership. Usually when real estate gets in trouble, you find out you're dealing with more than the equity holder. But there have been times when large amounts of real estate have changed hands at bargain prices, but usually stocks were cheaper, but they were a lot easier to do. So Charlie did more real estate. Charlie enjoyed real estate transactions, and he actually did a fair number of them in the last 5 years of his life. But he was playing a game that it was an interesting game to him. But I think if you'd asked him to make a choice when he was 21, he had to either be in stocks exclusively the rest of his life or real estate the rest of his life, he would have chosen stocks in a second. There's just so much more opportunity, at least in the United States. There's so much more opportunity that presents itself in the security market than it does in real estate. And in real estate, you're usually dealing with a single owner or a family that owns maybe a large property they've had a long time. Maybe they borrowed too much money against them. Maybe the population trends are against them. But to them, it's an enormous decision. When you walk down to the New York Stock Exchange, you can do billions of dollars worth of business totally anonymous, and you can do it in 5 minutes. And the trades are complete when they're complete. In real estate, when you make a big deal with a distressed lender, when you sign the deal, then you go into another phase. I mean, then people start negotiating more things, and it's a whole different game. And a different type of person, to some extent, enjoys the game. We did a few real estate deals that came our way in 2008 and 9, but the amount of time that they would take us compared to doing something intelligent and probably better in securities, there was just no comparison. I mean, in a real estate deal, every sentence is as important to the person, and in stocks, if somebody needs to sell 20,000 shares of Berkshire or something and they call us and the price is right, it's done in 5 seconds. And it closes all the time.
You calculate, I think you take all of the variables and calculate them reasonably conservatively, but you don't try and put too much windage in at every level. And then when you get all through, you apply the margin of safety. So I would say don't focus too much on taking it on each variable in terms of the discount rate and the growth rate and so on, but try to be as realistic as you can on those numbers, but with any errors being on the conservative side. And then when you get all through, you apply the margin of safety. Ben Graham had a very simple formula he used for just the most obvious situations, which was to take working capital, net working capital, and try and buy it at a third off working capital. And overall, that worked for him. But that method sort of ran out of steam when the sub-working capital stocks disappeared. But it's the same thing we do in insurance. I mean, if we're trying to figure out what we should charge for, we'll just say, the chances of a 6.0 earthquake in California. Well, we know that in the last century, I think there have been 26 or so 6.0 or greater quakes in California. And let's, forget about whether they occur in remote areas. Let's just say we were writing a policy that paid off on a 6.0 or greater quake in California, regardless of whether it occurred in a desert and did no damage or anything. Well, we would look at the history and we'd say, well, there have been 26 in the last century, and we would probably assume a little higher number in the next century. That'd just be our nature. But we wouldn't assume 50. If we did, we wouldn't write any business. So we might assume a little higher. If I was pricing it myself, I'd probably say, well, I'll assume they're going to be 30 or maybe 32 or something like that. Then when I get all through, I'll want to put a premium on it that now puts in a margin of safety. In other words, if I figured the proper rate for 32 is $1 million, I would probably want to charge something more than $1 million to build in that margin of safety. But I don't want to hit it I want to be conservative at all the levels, and then I want to have that significant margin of safety at the end. And I guess that, as I understand the question, that'd be my answer. And Charlie, you want to?
Yeah. Yes, volatility does not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure, or taught about risk, do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. I mean, actually, take it with farmland here in 1980 or in the early 1980s. Farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. And according to standard economic theory, market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now, people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, they would explain this away a little more technically, but they have in effect translated volatility into all kinds of past volatility in terms of all kinds of measures of risk. And it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing.
Sure, it's a good question. The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. I mean, that becomes a compounding machine. So if you have your choice, if you could put $100 million into a business that earns 20% on that capital, say 20 million, ideally it would be able to earn 20% on 120 million the following year and 144 million the following year and so on. That you could keep redeploying capital at these same returns over time. But there are very, very, very few businesses like that. Unfortunately, the good businesses, take a Coca-Cola or See's Candy, they don't require much capital. And incremental capital doesn't produce anything like the returns that this fundamental return that's produced by some great intangible. So we would love the business that could keep deploying, in fact, even well beyond the earnings. I mean, we'd love to have a business that could earn 20% on 100 million now, and if we put $1 billion more in it, it would earn 20% more on that $1 billion. But like I say, those businesses are so rare. There are a lot of promises of those businesses, but we've practically never seen one. There have been a few. Most of the great businesses generate lots of money. They do not generate lots of opportunities to earn high returns on incremental capital. We can deploy X at C's and earn a lot of money, but if we put 5X in, we don't earn any more money to speak of. We can earn high returns on X at the Buffalo News, but if we tried to make it 5X, we don't earn any more money. They just don't have the opportunities to use incremental capital. We look for them, but they don't. So you've seen, I mean, we will talk theoretically about the businesses that are going to earn more and more money with incremental capital at high returns. But what you've seen is that we've bought businesses largely that earn good returns on capital, but in many cases have limited opportunities to earn anything like the returns they earn on their basic business with incremental capital. Now, the one good thing about our structure at Berkshire is that we can take those businesses that earn good returns in their business but don't have the opportunity for returns of a similar magnitude on incremental money, and we can move that money around to buy more businesses.
Should wise people have known better?
Well, people always should know better. I mean, people don't get smarter about things that get as basic as greed and you can't stand to see your neighbor getting rich. You know you're smarter than he is, and he's doing these things, and he's getting rich, and your spouse is getting unhappy with you because you aren't doing it. Pretty soon you start doing it, and so you get what I call the natural progression, the 3 I's: the innovators, the imitators, and the idiots. That's what happens in financial markets. We've been through all 3, have we? Everybody just kind of goes along, and you look kind of silly if you disagree. I mean, you could have these crazy internet valuations in the late 1990s, but they proved themselves out in the market. I mean, the next day they were selling for more than they were the day before, and people said, you're crazy if you don't get in on this. So it's very human. Now, with housing, it's something even more dramatic than that, because most people aspire to own their own home. And if you really think that housing prices are going to go up next year and the year after, you feel, if I don't buy it this year, I'm going to have to buy it next year. That's not true of an internet stock, but it's true of a home. And then when somebody makes it very easy for you to do it by saying you don't really have to put up any money, or you can lie about your income a little, or we'll give you a 100% mortgage, you're going to do it because everybody that's done it has been proven right. You have what they call social proof, and you're going to feel like an idiot if you didn't do it. Next year the house costs more.
Hi, my name is Timothy Ferris. I am a guest lecturer at Princeton University twice a year, and I'd like to touch on an earlier question about investing with small sums of money. I'd like to ask both of you, if you were 30 years old again and had your first $1 million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents, and it'd be really helpful for my students, for myself and others here, if you could be as specific as possible about asset classes, percentages, whatever you're willing to offer.
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard. Somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this hasn't been, I would feel that was going to outperform to a degree bonds under current conditions over a long period of time, and then I'd forget it and go back to work. Charlie?
Yeah, it's in the nature of things that you aren't going to have a whole lot of screamingly successful professional investors. You've got a great horde of professionals taking croupiers' profits out of the system, most of them by pretending to be professional investors. And that is in the nature of things too. But if you don't have any rational prospects of being a very skilled professional investor, well, of course you should compromise on some simple thing like an index fund.
Yeah, and that you will not get that advice from anybody because nobody gets paid to give you that advice. And so you will have all kinds of people telling you how much better they can do for you than that, and how if you just give them a wrap fee or give them commissions or whatever it may be, that they will do better, but they won't do better. On average, 1,000 other people like you do the same thing. That group of 1,000 will do worse if they listen to the people that make pitches at them. And in the end, why should you expect, I mean, you'll get a very perfectly decent return over a 30 or 40-year period by doing what I suggest. And why should you expect more than that when you don't bring anything to the party? The salesman will tell you that you'll get it, but you won't.
Accounting can offer you a lot of insight into the character of management. And I would say there's a lot, you run into a fair amount of bad accounting. I used to call it creative accounting, but and you probably run into a lot more if it was allowed. But some companies have been able to push their auditors pretty far, and I would be very skeptical of anything that looks suspicious to you. I think there have been a couple of things written, but I can't think of where they've appeared, where people talk about the questions of what. Obviously, if some prepaid expense, deferred asset accounts start building up suspiciously high, and inventories look out of line, with sales and particularly the trend of them and all that, you want to look twice at companies like that. Life insurance, frequently we see weak accounting in it. When you don't have a product where revenues and expenses are being matched up on something close to cash in the short term, you have the opportunity for people playing games with numbers. And some people have learned how to do that very well, and they've sometimes created long-lasting stock manipulation or promotion schemes that have enriched themselves where they've enriched the managers or the creators of it at the expense of the public over time. If you ever get suspicious about accounting, just go on to the next company.
Practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in one century, and then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company; it's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way. It's pretty hard to rig $20+ trillion, and people should forget about it, calling it the stock market even. I mean, it's American business, and if for some reason you think American business over the next 50 years is likely to be way less productive than it has been in the past, then you could come to a negative conclusion on it. But I came to a conclusion on that farm that it was likely to produce a little bit more over the years, and that the crops would bring a little bit more over time, and I bought it on a 10% yield basis to start with. So when you're buying a productive asset, you don't want to categorize it by some name and then read in the paper that this or that's going to go up or down. You want to look at the business. If you bought the house next to you to rent to somebody, you'd look at the rent you were going to get, the taxes you were going to pay, and what you thought the neighborhood would do over a long period of time, and then you'd measure that against the purchase price. The purchase price is all important, and the stock market just offers you so many opportunities. Thousands and thousands of different businesses. You don't have to be an expert on every one of them. You don't have to be an expert on 10% of them even. You just have to have some conviction that either a given company or a group of companies, and I would suggest for most people it should be a group of companies, you have to have a conviction that those companies are likely to earn more money 5 or 10 or 20 years from now than they're earning now. And that is not a difficult decision to come to.
Is there a price at which it's inappropriate for a company to use its capital buyback its stock?
Give me that again.
For example, Coca-Cola at 40 PE. Is that a smart place for Coke to deploy capital?
Well, it sounds like a very high price when you name it in terms of a PE to buy back the stock at that sort of number. But I would say this: Coca-Cola's been around 112 years now, and There are very few times in that 112 years, if any, when it would not have been smart for Coca-Cola to be repurchasing its shares. Coca-Cola is probably, in my view, among businesses that I can understand, it's the best large business in the world. I mean, it is a fantastic business. And we love it when Coke repurchases shares and our interest goes up. We owned 6.3% of Coca-Cola in 1988 when we bought in. We actually increased that a little bit a few years later. But if they had not repurchased shares, we probably would own about 6.7% or 6.8% of Coke now. As it is, we own a little over 8% through repurchases. There are going to be about 1 billion 8-ounce servings of Coke sold around the world, or Coca-Cola products sold around the world today. 8% of that is 80 million, and 6.8% is 68 million. So there are 12 million extra servings for the account of Berkshire Hathaway being sold around the world. And they're making a little over a penny a serving, so, you know, that gets me kind of excited. And I think all I can tell you is I approve of Coke repurchasing shares. I'd a lot rather have them repurchasing shares at 15 times earnings, but when I look at other ways to use capital, I still think it's a very good use of capital. And maybe the day will come when they can buy it at 20 times earnings, and if they can, I hope they go out and borrow a lot of money to buy a ton of it at those prices. And I think we will be better off 20 years from now if Coke follows a consistent repurchase approach. I do not think that is true for many companies. I mean, I think that repurchases have become in vogue and done for a lot of silly reasons. And so I don't think everybody's repurchase of shares is well reasoned at all. You know, we see companies that issue options by the ton and then they repurchase shares much higher. You know, I started reading about investments when I was 6, and I think the first thing that I read was, you know, buy low, sell high. But these companies, through their options, you know, they sell low and then they buy high, and they've got a different formula than I was taught. So there are a number that we don't approve of. But when we own stock in a wonderful business, we like the idea of repurchases even at prices that may give you nosebleeds. It generally turns out to be a pretty good policy. Charlie?
Well, I think the answer is that in any company, the stock could get to a price so high it would be foolish for the corporation to repurchase its shares.
Sure.
And you can even get into gross abuse. Before the crash, the Insul utilities were madly buying their own shares as a way of promoting the stock higher. It was like a giant Ponzi scheme at the end. So there's all kinds of excess that's possible, but the really great companies that buy at high price earnings, that can be wise.
Our interest in Geico went from 33% to 50% without us laying out a dime, because Geico was repurchasing its shares. And we benefited substantially, but we benefited a lot more, obviously, when prices were lower. I mean, our interest in the Washington Post company has gone from 9.5% to 17.5% over the years without us buying a single share. But the Post or Coke or any number of companies don't get the bargain in repurchasing now that they used to. We still think it's probably the best use of money in many cases.
Mr. Buffett, I was reading recently in Fortune magazine that when you invested $500 million in PetroChina back in 2001 or 2002, all you did was read the annual report. Now, I was thinking that most professional investors with the kind of resources that you have would have liked to have done a lot more research and talk to management, maybe regulators, etc., etc. The question I have is what is it that you look for when you're reading an annual report like that? How is it that you were able to able to and did make an investment purely on the back of reading that report?
Yeah. Well, it was in 2002 and 2003, and the report came out in the spring, and I read it. And that's the only thing I ever did. I never contacted any management. I never got a brokerage report. I never asked for anybody's opinion. But what I did do was I came to the conclusion that the company, and it's not hard to understand crude oil production and refining and marketing and the chemical operation they have. I mean, you can do the same thing with Exxon or BP or any of them, and I do that with all. I look at them. And I came to the conclusion it's worth $100 billion, and then I checked the price and it was selling for $35 billion roughly. What's the sense of talking to management? I mean, basically, if you talk to management of almost every company, they'll say they think their stock's a wonderful buy, and they'll give you all the good stuff and skip over things that it just doesn't make any difference. Now, if I thought the company was worth $40 billion and had been selling for $35 billion, then at that point you have to start trying to refine your analysis more. But there's no reason to refine your analysis. I mean, I didn't need to know whether it was worth $97 billion or $103 billion if I was buying it at $35 billion. So any further refining of analysis would be a waste of time when what I should be doing is buying the stock. So we really like things that you don't have to carry out to 3 decimal places. If you have to carry it out to 3 decimal places, it's not a good idea. And it was something like PetroChina. It's like if somebody walked in the door here and they weighed somewhere between 300 and 350 pounds, I might not know how much they weigh, but I would know they were fat. That's all I'm looking for, is something that's financially fat. And whether PetroChina weighed $95 billion or $105 billion didn't make much difference. It was selling for $35 billion. If it had been selling for 90, it would have made a difference. So if you can't make a decision on something like PetroChina off the figures, forget about going further. And that's basically what we did. It's a straightforward report, just like reading just like reading Chevron's or ConocoPhillips or anything like that, just as informative. We're going to learn more, by going out and deciding whether you thought they've got one huge field in China, whether the life of it was 13 years or 14 years or something of the sort. They should hit you between the eyes. Charlie?
Yeah, I would argue that we have lower due diligence expenses than anybody else in America, and that we have had less trouble because we had less expense. I know of an investment operation in America that pays over $200 billion a year to its... 200 million. Yes, yeah. 200 million, pardon me, to every year to its accountants, a lot to help them with due diligence. And I think our operation is safer because we think like engineers. We want these margins of reliability, and they're trying to do something really difficult, which is to have fine-grained.
When we get a call on something like the Mars-Wrigley situation, if we don't know enough about Mars and Wrigley by this point, so that we have to go out, I still like to go out, and of course, and sample all the bars. So we have a 15. I mean, I feel I owe that to the Berkshire shareholders, but I'm not going to look at their labor contracts or their leases or anything like that. If the value of Wrigley depends on a specific lease someplace or a specific commitment to this or that, or a given environmental problem, forget it. There are these overriding considerations that are enormously important, and then there's a whole lot of trivia that doesn't mean anything. That we have never made we've made plenty of big investment. I've made plenty of big investment mistakes. I've never made one, in my view, that would have been avoided by conventional due diligence. And we would have spent a lot of money, and we would have wasted a lot of time, and in some cases we would have missed deals simply because we wouldn't have committed fast enough.
It's also the toughest to explain. I look for certain, you look for certain things that allows you to narrow it down, like I was saying about the Spassky-Fisher situation. So if I'm a basketball coach, and I see a guy, I'm walking around the campus here, and I see somebody 7 feet tall, I'm interested. Now, he may not be coordinated. We may not be able to keep him in school. He may be robbing stores at night or something, but he's still the right guy to be looking at. I mean, we can work with this guy. So I am interested in 7-footers, maybe 6'10". And if I see some guy that's 5'3", and he comes up to me, and he's dribbling away, and he's telling me, doing fancy moves, and he says, "Coach," I said, "I'm your guy." I say, "Yeah, but, if you get in there against these 7-footers, I'm not sure he'll be dribbling exactly the same way. I'm going to skip him. He may be a wonderful prospect and all that, but I'm not interested. So I am looking for signals that tell me in investments what height and a few things might tell me if I was a basketball coach. In the end, what I'm going to buy is the business where I feel extremely certain about the competitive advantage, extremely certain about the integrity and ability of the management, and where I think the discounted flow of the cash that business will produce over time makes sense in relation to its current price. You really are looking for a business where you see the future. And that's why we don't get in tech. It isn't that I don't love the computer and think it's doing all kinds of things for society. I just don't know what it's going to look like in terms of who's going to be selling what to whom and at what prices and against whom and all of that sort of thing 10 years from now. Whereas I know that people are going to be chewing Wrigley's chewing gum in 10 years. I mean, people sitting in front of a computer chewing gum will not behave way differently than people chewing gum, in this audience as we talk. I mean, there are certain things that won't be affected. Gillette razor blades. I mean, that 70% of the value worldwide of razors and blades is Gillette. That's after almost 100 years of shaving, and everybody knows what a razor blade does. They all know how to buy the steel. They all know how to sell it through Walmart or whomever. But 70% of the world. Now, part of that's because men don't like to change as much. I mean, if a man gets happy with something, he doesn't fool around with it a lot. Women are a little more inclined to experiment. But for $25 a year, something you do every day, you get a wonderful experience with Gillette. What better is the world going to offer you? You're getting a claim currently about some 4-blade razor, but don't worry about that one. The 70%, just think of that. Coca-Cola, 19 billion cases of Coke. I mean, not Coke, but Coke products sold a year. Everybody in the world drinking it. Do you think, will that change dramatically in the next 10 years? I'd bet my life against that. We sell See's candy in California. There's 35 million people in California. They did the right thing last Tuesday, incidentally. People ask how I got involved in the Schwarzenegger campaign. I won a look-alike contest. I mean, but here they are, 35 million people. Everybody in California has something in their mind about See's candy. What candies are in your mind? Number one candy bar is Snickers. Number one candy bar 10 years ago was Snickers. Number one candy bar 20 years ago was Snickers. People don't fool around with candy bars. I mean, you cannot come out with lots of new bars and intrigue people. It's not like, perfume or other things maybe where people experiment. If you go into the drugstore and you say, "I want a Snickers bar," and it's 60 cents, and the druggist says, "I've got something just as good for 55 cents called Joe Schmo's, caramel and nut bar," you're going to walk across the street. Now, when you walk across the street for a product, then you got a business. I mean, that is the test. And where a nickel doesn't make a difference. And so it's, there is no good way to compete with Snickers. You want something where price competition is not solely going to be the determining factor. And that's true of razor blades, it's true of Snickers, it's true of See's candy, it's true of Coca-Cola, and there's a lot of things of which it isn't true. That mode is what is differentiation of product, differentiation of service, differentiation of location, whatever it may be. And that's essential. I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt that was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
I know you look at things like that, but I also know that you look at stocks and try to decide if they're fairly valued, if they're overvalued, if they're looking cheap at this point. And we have been waiting for a correction for an awfully long time. That's finally come. Do stocks look cheaper to you, just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But stocks are going to go down. You could probably look it up as to what percent of the days since I was born they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do, but in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497, and you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Yeah, unfortunately, that's the biggest problem, is trying to fight yourself in some of these situations.
Yeah.
Have you been buying more stocks lately just because prices have come down? Have you upped your percentages and other things just
We're
because?
almost always a buyer of stocks. So we have bought more stocks since the end of the year. But we earned 17 and a fraction billion last year, and we had our float go up 4 billion, which is additional money available. And so we're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down, but it's hard to think of very many months when we haven't been a net buyer of stocks.
Warren, thank you very much for joining us today.
My pleasure.
What we're trying to get to the bottom of is, what was the worst trade you ever made, and what'd you learn from it?
The dumbest thing I ever did.
Yeah, the dumbest thing you ever did.
The dumbest stock I ever bought was, drum roll here, Berkshire Hathaway. And that may require a bit of explanation. It was early in 1962, and I was running a small partnership, about 7 million. They call it a hedge fund now. And here was this cheap stock, cheap by working capital standards or so, but it was a stock in a textile company that had been going downhill for years. So it was a huge company originally, and they kept closing one mill after another. And every time they would close a mill, they would take the proceeds and they would buy in their stock. And I figured they were going to close. They only had a few mills left, but they would close another one. I'd buy the stock, I'd tender it to them, and make a small profit. So I started buying the stock. And in 1964, we had quite a bit of stock. And I went back and visited the management, Mr. Stanton. And he looked at me and he said, Mr. Buffett, we've just sold some mills. We've got some excess money. We're going to have a tender offer. And at what price will you tender your stock? And I said, $11.50. And he said, do you promise me that you'll tender at $11.50? And I said, Mr. Stanton, you have my word that if you do it here in the near future, that I will sell my stock at $11.50. I went back to Omaha, and a few weeks later, I opened the mail.
Oh, you have this.
And here it is, a tender offer from Berkshire Hathaway. That's from 1964. And if you look carefully, you'll see the price is 11 3/8. He chiseled me for an eighth. And if that letter had come through with 11 1/2, I would have tendered my stock. But this made me mad. So I went out and started buying the stock, and I bought control of the company and fired Mr. Stanton. And we went on from there. Now, that sounds like a great little morality tale at this point. But the truth is, I had now committed a major amount of money to a terrible business. And Berkshire Hathaway became the base for everything pretty much that I've done since. So in 1967, when a good insurance company came along, I bought it for Berkshire Hathaway. I really should have bought it for a new entity, because Berkshire Hathaway was carrying this anchor of all these textile assets. So initially it was all textile assets that weren't any good, and then gradually we built more things onto it. But always we were carrying this anchor, and for 20 years I fought the textile business before I gave up. And if instead of putting that money into the textile business originally, we just started out with the insurance company, Berkshire would be worth twice as much as it is now. So,
twice as much?
Yeah, this is $200 billion. You can figure that comes about because the genius here thought he'd run a textile business.
Why $200 billion?
Well, because if you look at taking that same money that I put into the textile business and just putting it into the insurance business and starting from there, we would have had a company that, because all of this money was a drag. I mean, we had a net worth of $20 million, and Berkshire Hathaway was earning nothing year after year after year after year. And so there you have it, the story of a $200 billion. And incidentally, if you come back in 10 years, I may have one that's even worse.
If you had to look at a moral for that story, though, is it don't cut off your nose to spite your face?
I would say that no matter whether you've cut off your nose to spite your face or whatever, if you get in a lousy business, get out of it. I mean, it was a terrible mistake just because I drifted into it in a sense. And you know, I've always said that if you want to be known as a good manager, buy a good business. I mean, that's the way to do it, and then everybody will think you're smart. And when I'm in a good business like See's Caddy, people think, boy, that guy's smart. And when I'm in a dumb business like textiles and don't know what I'm doing, you know, or shoes later on, or whatever it may be, you know, and all that other, if you think you're a managerial genius, just try yourself in a bad business.
Is that the lesson that you learned from
Sure.
it, though? And that is something that you've actually put into practice?
I've actually put a line in my annual report many decades ago after doing this. And I said, when a manager with a reputation for brilliance meets up with a business with a reputation for bad economics, it's the reputation of the business that remains intact.
So that is a lesson you carried with you, and yet it's one that is you're reminded of every single day. It's Berkshire Hathaway.
Yeah, and every now and then I get tempted because I started out with Ben Graham in 1950 or so, and his whole idea was buying things that were cheap. You don't want to buy things that are cheap. You want to buy things that are good. It's much better to buy something that's good at a fair price than something that is cheap at a bargain price. And I didn't start out that way. I was taught a different system, but if I didn't learn from Berkshire Hathaway, I'll never learn it.
How long did it take you to figure out this lesson? You said it was
it took me 20 years to give up on the textile business. I had a wonderful guy running it after Seabury Stanton. A fellow named Ken Chase ran it, and he was terrific. Honest and able, hardworking, and he couldn't make it go. But we just kept working at it. We bought another textile company called Wambeck Mills in Manchester, New Hampshire. Another mistake. If you're going to be brilliant with a lousy business, why not be brilliant with a good business?
But really, it took 20 years for you to finally give up on it. When did you kind of figure, oh, this is not working? Was it really 20 years, or did you kind of?
No, I figured it out fairly soon, but I just kept thinking I'm not going to give up on this. And incidentally, we had a workforce that was terrific. I mean, it was, we weren't done in it by anything except competitive dynamics. And we'd buy new equipment, or we would add this mill in Manchester, and we'd say, look at all the synergies and all that. Nothing works. In fact, I used to have a desk in my drawer, and they would keep sending me these things that if we buy this machine, we'll save 14 people. If we buy this machine, we'll save 12 people. I kept putting in my drawer, we bought all those machines, we'd save more people than we had at the start of the, supposedly we were operating with 0 people, but it doesn't work that way.
Is there any business that you didn't get into because you thought, wait a second, I've been down this road before, where you were tempted and you kind of pulled back?
I get calls on them every day. You know, I mean, I get calls, not every day, I mean, it's an exaggeration, but I get calls frequently on businesses that are just too tough, you know, and people say, you know, why don't you tackle it? You know, you've got all these resources now and good managers. But the interesting thing about business, it's not like the Olympics. In the Olympics, you know, if you do some dive off the high board and have 4 or 5 twists and everything on the way down, and you go into the water a little bad, there's a degree of difficulty factor. So you get more points than some guy that just does a little head first dive in perfectly. So degree of difficulty counts in the Olympics. It doesn't count in business. You don't get any extra points for the fact that something's very hard to do. So you might as well just step over 1-foot bars instead of trying to jump over 7-foot bars.
You know, people will say, well, wait a second, you're in some businesses that some people have written off for dead. The newspaper business, how is that different?
They're right. But we bought that in 1977, and we've done very well over the years. At first, we didn't do so well, but then we did very well. But the newspaper business of 2010 is not the newspaper business of 1977. I mean, it is diametrically different. And it is true, and we put it in the annual report, that we run this Berkshire in a way that they don't teach in business schools. Because in business schools, they say, sell off your so-so businesses and keep buying new businesses. I call that gin rummy management. And if I have 50 kids, you know, and one of them isn't doing quite as well as the others, I'm not going to put them out for adoption unless they are going to lose this money permanently, or if they have major labor difficulties. We keep the businesses that aren't as good as the others. So So if I'm going to follow that philosophy, I better be very careful about what I buy, right?
Exactly. What about your business partner, Charlie Munger? What would he say your biggest mistake is?
Well, he would probably repeat this, and I would say I've learned a lot about what I've just got through talking about. I've learned a lot from Charlie. Charlie told me this from the first moment I met him in 1959. He said exactly, I could have saved myself a lot of trouble if I just listened to him, but what did Charlie know?
Okay, Warren, thank you very much. We really appreciate your time.
Thanks for having me.
You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they'd made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
I wouldn't be surprised if it's not around in 10 or 20 years. It's a method of transmitting money. It's a very effective way of transmitting money, and you can do it anonymously and all that. A check is a way of transmitting money, too. Our checks are worth a whole lot of money just because they can transmit money. Our money orders, you can transmit money by money orders. People do it. I hope Bitcoin becomes a better way of doing it, but you can replicate it a bunch of different ways, and it will be. The idea that it has some huge intrinsic value is just a joke, in my view.
In terms of cryptocurrencies generally, I can say almost with certainty that they will come to a bad ending. Now, when it happens or how or anything else, I don't know. But I know this, if I could buy long-term puts, if I could buy a 5-year put on every one of the cryptocurrencies, I'd be glad to do it. But I would never short a dime's worth. We don't own any, we're not short any, we'll never have a position. I think that anytime you buy a non-productive asset, you are counting on somebody else later on to buy a non-productive asset because they think they can sell it to somebody for more money. And it's been tried with tulips, and it's been tried with various things over time, and it does come to a bad ending.
To me, it's just dementia, and I think that people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out.
When I was tweeting the things that you and Charlie were saying about this weekend, all I was doing was repeating what you were saying, and people were coming back with some pretty angry comments, including things like, I bought a house buying cryptocurrency, you're outdated on this. They said a lot meaner things, that you don't understand it, so you should shut up about it. You're not.
Well, the interesting thing is if you're investing, you don't worry whether people say, if I'm investing in Apple, I love the idea of people saying Apple is terrible because I want the stock to go down because they're repurchasing shares and my interest will go up faster. You don't get defensive if you're buying something that produces that. You get defensive when you look at this thing and it doesn't do anything. You're just hoping somebody comes along to pay you more tomorrow or the next day, and you're dependent on more people, the mob growing, basically. So those people do get angry.
Has your position changed on Bitcoin?
No, I mean, it's too bad, but Bitcoin, it's ingenious, and blockchain is important, but Bitcoin has no unique value at all. It doesn't produce anything. You can stare at it all day and no little Bitcoins come out or anything like that. It's a delusion, basically.
As you know, the U.S. national debt is currently at an estimated $31 trillion, making up about 125% of the U.S. GDP. In the meantime, over the past few years, the Federal Reserve has telegraphed that they intend to monetize the debt by printing trillions of dollars, even as they insist that they're fighting inflation. My question is, are we likely to face a time in the future when the U.S. dollar is no longer the global reserve currency?
I mean, we are the reserve currency, and I see no option for
any other currency to be the reserve currency. And nobody knows how far you can go with the paper currency before it gets out of control, and particularly if you're the world's reserve currency. Nobody knows the answer to that. And you don't want to try and pick out the point at where it does become a problem, because then it's all over. And I think we should be very careful. I mean, we all learned Keynesianism, and we applied it in World War II to the advantage of the country. And we did everything we could to prevent inflation during the war. And then the war ended in August of 45. And I think in January 46, and I'm not giving you exact figures at all now, but in January 46, I think the rate of inflation was at, something like 1% or thereabouts. And by the end of the year, I think it was at like 15%. And again, I'm doing this from long memories. But it's easy for America to do us a lot. But if we do too much, it's very hard to see how you recover once you let the genie out of the bottle and people lose faith in the currency. And they behave in an entirely different manner than they do when they feel that if they put some money in the bank or have a pension plan or whatever it may be, that they're going to get out something with roughly equal purchasing power. And it just changes the economy, and all kinds of things can happen then. I can't predict them, and nobody else can predict them, but I do know they aren't good.
My name is Andrew Nickus, and I'm wondering, if you had one more day with Charlie, what would you do with him?
Well, it's kind of interesting because, in effect, I did have one more day. I mean, it wasn't a full day or anything, but he, we always lived in a way where we were happy with what we were doing every day. I mean, Charlie liked learning. He liked, as I mentioned in the movie, he liked a wide variety of things. So he was much broader than I was. But I didn't have any great desire to be as broad as he was, and he didn't have any great desire to be as narrow as I. But we had a lot of fun doing anything. And, we played golf together, we played tennis together, we did everything together. And this you may find kind of interesting. We had as much fun, perhaps even more to some extent, with things that failed, because then we really had to work our way out of them. And in a sense, there's more fun having somebody that's your partner in digging your way out of a foxhole than there is just sitting there and watching an idea that you got 10 years ago just continually produce more and more profit. So it wasn't, he really fooled me, though. He went to 99.9 years. I mean, if you had picked two guys, he publicly said he never did a day of exercise except where it was required when he was in the Army. So he never did a day of voluntary exercise. He never thought about what he ate. We started every day, and Charlie he was interested in more things than I was, but we never had any doubts about the other person, period. And so if I'd had another day with him, we'd probably done the same thing we were doing the earlier days, and we wouldn't have wanted to know that we only had one day. There's a great advantage in not knowing where you're going to, what day you're going to die. And Charlie always said, that just tell me where I'm going to die, so I'll never go there. Well, the truth is, he went everywhere with his mind, and therefore he was not only interested in the world at 99, but the world was interested in him. It's remarkable. I told him in the last few years, I'd never seen anybody that was peaking, at 99 and where the world wanted to come and see him. I mean, they actually wanted to go out to 351 North June Street, and whether it was, well, I could name a whole bunch of names, but just I'll start with Elon Musk, but go down the list, and they all wanted to meet Charlie, and Charlie was happy to talk with them. And the only person I could think of otherwise was the Dalai Lama. I don't know that they had a lot else in common, but it was, he lived his life the way he wanted to, and he got to say what he wanted to say. He, like I, loved having a podium, and again, I can't remember any time that he was mad at me or I was mad at him. It just didn't happen. And calling him was fun back when long distance rates were high, and we didn't talk as often as in recent years as we used to be on daily for long periods. And we did keep learning, and we liked learning together. But, we tended to be a little smarter because as the years went by, because we had mistakes and we had other things where we learned something, and the fact that he and I were on the same wavelength in that respect meant that the world was still a very interesting place to us when he got to be 99 and I got to be 93. So I don't have a perfect answer for you there, but I can tell you the ingredients that would go into. Sometimes people would say to me or Charlie at one of these meetings, if you could only have lunch with one person that lived over the last 2,000 or so years, who would you want to have it with? Charlie says, I've already met all of them, because he read all the books. I mean, he eliminated all the trouble of going to restaurants to meet him or anything like that. He just went through a book, and he had met Ben Franklin, and he really he was remarkable. He said he really had no one else to meet because he'd read all their stuff, and he liked Ben Franklin's stuff better than he liked mine. But with Ben Franklin, he just had to read about it. They didn't have to go have lunch with him or anything of the sort. But it's an interesting question. What you should probably ask yourself is that, who do you feel that you'd want to start spending the last day of your life with, and then figure out a way to start meeting them or tomorrow, and meet them as often as you can. Because why wait till the last day? And don't bother with the others.
Warren, how would you define true success?
Well, I've said many times that if you get to be 65 or 70 and later, and the people that you want to have love you actually do love you, you're a success. I've never seen anybody that reaches that age. I mean, I'm not talking about somebody that's in extreme poverty or pain or something, but I've never seen anybody that, if they have a lot of people that love them, that is other than happy. And I've seen some very, very wealthy people that they give testimonial dinners to and name schools after and everything. And nobody loves them, Their own kids would say, he's in the attic, Nobody ever came.
What are, say, 3 pieces of advice you would give to people who are looking to succeed in business?
Well, by far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, and both in writing and in person, they increase their value at least 50%. And I mean, if you can't communicate, somebody says, it's like winking at a girl in the dark. Nothing happens, basically. And you have to be able to get forth your ideas. And that's relatively easy. I did it myself with the Dale Carnegie course. Some people wish I'd taken a shorter course now in terms of my talking later on. But it's just hugely important. And if you invest in yourself, nobody can take it away from you. I mean, the second thing, which I'll get a certain criticism for not living it, but I do tell those students, that if I gave you a car and it'd be the only car you get in the rest of your life, you take care of it like you can't believe. Any scratch, you'd fix that moment. You'd read the owner's manual. You'd keep a garage and do all these things. And you get exactly one mind and one body in this world. And you can't start taking care of it when you're 50. By that time, you'll have rusted out if you haven't done anything. So you should really make sure that you just remember that you just got one mind and body to get through life with and to do the most with it.
What about life advice?
Well, life advice is, the most important thing, aside from the things I've talked about already, is really who you associate with. You want to associate with people that are better than you are. I mean, basically, you'll go in the direction of the people that you associate with, and you want to have the right heroes. You want people, if you want to emulate somebody, you better pick very carefully who you want to emulate. And when obviously you can't pick your parents, they're going to have an enormous influence on you, but you don't get a choice on that. But you get choices as you go down the line, and who you admire, who you want to copy, and the most important for most people in terms of that decision is their spouse. It's also important in terms of a partner in business, but the partner in life is the most important one. You want to pick a spouse that's better than you are, and then he or she, and you hope they don't figure it out too fast.
Great. Biggest mistakes people make when investing?
Well, they try to, they just don't realize that all you have to do is just buy a cross-section of America and then never listen to people like me or read the papers or do anything subsequently. They think that because you can trade, you should trade. You buy a farm, you buy an apartment house, you can't resell it tomorrow, and the cost of moving around. Now you get something handed to you, liquidity, which is instant. You can sell, and the cost of doing it are pennies, compared to other kinds of investment activity. So because they can so easily move around, they do move around, and moving around is not smarter than investing.
You have a pretty cool morning routine regarding what you have for breakfast and how prosperous you feel. What is that?
Well, I now actually send somebody over to McDonald's usually to get me something. Since the publicity I got from earlier describing my habits at McDonald's, I now have somebody go in the office, but that was more for entertainment value. I eat exactly what I like to eat. If I liked it on my 6th birthday, at my 6th birthday party when we had hot dogs and hamburgers and Coke and ice cream with chocolate, I still like it. And I don't care about anything subsequently. I discovered it all by the time I was 6. If somebody offered me a deal when I was 20 and said, you're going to live 1 year longer, instead of living to 88, you'll live to 89 or whatever it may be, if you eat nothing but broccoli and Brussels sprouts and onions and all these things, I just said, I'll take the last year off. It probably won't be that good anyway. So I eat what I like to eat. I'm not venturesome in that area.
I like how you lumped in onions with broccoli and Brussels sprouts. Well, never heard that.
I just don't happen to like onions, but I don't put them in the same category.
Okay. You and George H.W. Bush, I think. Is business school worth it?
Depends on the person. Much more than it depends on the school. I mean, I wouldn't worry. Some people are going to get a lot out of advanced education, and some people are going to get very little. And I don't even think it's important that every person go to college at all. I mean, we have all kinds of jobs at 70 or so thousand a year, or 80,000 a year, that college training is not of use. And I actually was not keen on going to college myself. Yeah, my dad kind of jollied me into it. He could get me to do anything, but
if they'd had an SAT test in those days, he would have taken the test for me. but because I knew I could have a good time, and I liked investing, and I didn't really feel I could read the books. So I don't, it's a big commitment to take 4 years, and the cost involved, and maybe the loans involved, and everything. And I think, depending on what your interests are in life, I don't think it's for everybody. I think it's for a lot of people, but there ought to be a reason you're going, and I didn't really see much reason.
All right, last question. So lightning round, so it's a few. Do you ever drink water?
Only under duress.
What is your favorite all-time song, Warren?
It's undoubtedly, it's My Way.
What about movie? Favorite movie?
Well, I like The Bridge on the River Kwai because of there were a lot of lessons in that. Plus, it was enormously fascinating.
Catchy tune, also.
Pardon me?
Catchy tune, also.
Yeah,
Right.
very.
Right.
But the ending of that was sort of the story of life. He created the railroad, and did he really want the enemy to come in and cross it?
Got it. Favorite book?
Well, the favorite book from an the book that had the most impact on my life was The Intelligent Investor by Ben Graham.
I knew you were going to say that. Favorite TV show?
It's probably going to be it would be Nebraska in some huge bowl game and winning.
And finally, what do you carry in your wallet, and how much money do you tend to carry around?
Well, I probably carry maybe $400. I actually my wife likes to use cash, so I just take home a chunk of cash every now and then she doles it out. She looks at my billfold and sees whether all the hundreds are gone.
Warren? Yeah, it's that's one thing we've really never talked about here, but I spend more time looking at balance sheets than I do income statements. And Wall Street really doesn't pay much attention to balance sheets, but I like to look at balance sheets over an 8 or 10 year period before I even look at the income account. Because there are certain things that's harder to hide or play games with on the balance sheet than you can with the income statement. And I mean, neither one gives you the total answer on anything, but you still ought to understand what the figures are saying and what they don't say and what they can't say and what the management would like them to say that the auditors wouldn't like them to say. And I mean, there's just a lot to be learned, and you do learn more. You learn more from balance sheets, in my view, than most people give them credit for. In terms of, I really haven't. I'm not worried about being remembered about that. People don't remember. Well, they don't remember enough about Katharine Graham, for example, in terms of this story that shaped America in many ways. Certainly, it had just all kinds of impact. And I think, I mean, history is so fascinating. And Charlie was probably the best person you could imagine in what he learned. Charlie was never satisfied with just superficial things about any subject. He really wanted to understand it. And he always would tell me that, don't take a position on anything until you can describe the arguments against it better than the person who is arguing with you, that you should be able to argue their case better than they can. He was a remarkable teacher, and but so were those other fellows I mentioned. I've had and of course my dad was an incredible teacher. So you make the most of the people you meet that are going to make you a better person, and probably forget about the rest to quite an extent.
In the book about Charlie, Damn Right, by Janet Lowe, Charlie talks about his view on teaching finance. He says that he would use the histories of 100 or so companies that did something right or wrong as a basis for teaching the course. Could each of you, and since this concerns Charlie, could each of you, we'll start with Charlie, give us an example or two from either category, right moves or wrong moves?
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a business that became the best in the world in its category. And it did it with an extreme meritocracy and an extreme ethical duty, self-imposed, to take all its cost advantages as fast as it could accumulate them and pass them on to the customers. And of course that created ferocious customer loyalty. And it's been a wonderful business to watch. And of course strange things happen when you do that and do that long enough. Costco has one store in Korea that will do over 400 million in sales this year. These are figures that can't exist in retailing, but of course they do. And so that's an example of somebody having the right managerial system, the right personnel selection system, the right ethics, the right diligence, and et cetera, et cetera. That is quite rare. And if once or twice in a lifetime you're associated with such a business, you're a very lucky person.
Charlie and I were on a plane recently that was hijacked.
With what?
It was hijacked. I'm telling about our experience on that hijacked plane when the hijackers picked us out as the two dirty capitalists that they really had to execute. But they were a little abashed about it. They didn't really have anything against us. So they said that each of us would be given one request before they shot us. And they turned to Charlie and they said, "What would you like as your request?" Charlie said, "I would like to give once more my speech on the virtues of Costco with illustrations." And the hijacker said, "Well, that sounds pretty reasonable to me." And he turned to me and said, "And what would you like, Mr. Buffett?" And I said, "Shoot me first."
Yeah. Well.